Hi there, everyone, and welcome. We've got a few attendees who. My name is Vanda Vickers, and I'm the Chief Operating Officer from the Global Risk Institute. And I'm delighted to welcome you to today's webinar, Deeper Dive into Assessing Inflation in Goods and Asset Markets. Although this event is virtual and many of you are joining us from across Canada and beyond, I'd like to acknowledge that the Global Risk Institute is headquartered in Toronto, which is situated on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is now home to many diverse First Nations, Inuit, and Métis peoples. I acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Before we begin today's session, I'd like to review a few housekeeping details. Please note that your microphones have been muted to avoid background noise, but we've allocated ample time for questions, which we'll take through the chat function, which you can see on the bottom right-hand corner of the screen. We'll address as many questions as we can during the question and answer period of this event. This session is being recorded and will be shared in the past events page on our website, where you can find many of our past events. And finally, when leaving the event today, a survey prompt will appear, and your feedback is very valuable to us, and we appreciate your consideration in completing that. So now I'd like to introduce our moderator for today's session, Jason Stewart, who's an executive in residence at the Global Risk Institute. Jason, over to you.
Thanks, Vanda. Good afternoon. Today's session is the third in GRI's macroeconomic webinar series. It follows our first webinar on the impacts and risks of the Bank of Canada's policy normalization, and our second webinar on central bank challenges, especially the Fed's narrow path to successfully unwind ultra-easy monetary policy. Our webinar today on assessing inflation will feature a presentation and remarks from Derek Holt. We will then move to the Q&A component with Derek that I will moderate. I'm pleased now to introduce Derek. Derek Holt is Vice President and Head of Capital Markets Economics for Scotiabank. He leads the development and application of economic, monetary policy, fiscal policy, and financial market forecasts and research for global and institutional investors and other major clients of Scotiabank. Derek joined Scotiabank's trading floor from a senior role with another Canadian bank. He has split his 27-year career in both bank and trading floor settings, serving a wide variety of capital markets, corporate, and retail clients in North America, South America, Europe, and Asia. Derek is frequently cited in the press for his views. He holds graduate degrees in both economics and finance, as well as the Chartered Financial Analyst designation. Welcome, Derek, and please begin.
Thank you for joining us for this discussion about inflation. What went wrong on inflation? Will it persist? And are we properly measuring it? And collectively, we'll make some progress, I hope, toward answering some of these questions, at least within the next hour. But there are many more questions that will remain unanswered in terms of the complexity of the issues involved. I'd like to thank Vanda and Jason for including Scotiabank Economics, Scotiabank in general, and myself in this event and within your organization. I'd like to especially thank you for holding a discussion on a topic that affects us and hits us all in the wallet today, instead of holding off on a discussion on inflation forecasts until April 1st, which would invite perhaps some unfortunate comments if we were to have done so. So it's a very good starting position to dive into our views on inflation. With the next slide, please. And I'm very thankful for Karen's assistance in flipping through the slides as we go through. First off, I want to set a level playing field for all of us. From the standpoint of the required dose of humility that we all need in assessing, forecasting, and understanding inflation, we all have to appreciate that, quite frankly, nobody did a great job at forecasting inflation. And we have an awful lot to learn going forward. That accountability perspective is provided in this chart. It shows that if we take the actual performance of Canadian inflation last year and compare it to how the Consensus Economics Survey of Canadian economists evolved month by month, or to our red line on this chart, our own performance, we all generally caught on to inflation risk gradually over the year and chased the numbers higher toward a better understanding that we think we may have now in terms of the complexity of the forces we're dealing with. Institutional investors, market participants, traders, portfolio managers, they had the same pattern of experience over the past couple of years. We see that in market proxies for inflation expectations in the chart shown on the right-hand side of this slide. It shows 5 and 10-year break-even rates, expected inflation rates derived from real return bonds in Canada. They too generally caught on a little bit too late and accelerated their pace of inflation worries later on in the year and into early this year. Having said that, the next slide shows that inflation risk was a bit of a different matter. Here you had a much greater cross spectrum of opinions across economists, central bankers, and market participants. There was, at the extreme, there were those who were arguing that this was all transitory. It would all fade in short order. It was something to see through. At the other extreme, you had people saying that this really was a different set of challenges and circumstances this time around. Even within central banks, that was the case. This chart is showing the number of FOMC participants reporting weighted upside risk to their inflation projections and how they grew in number over the course of 2021, considerably in advance of when Chair Powell pivoted at the December FOMC and in his press conference. We can't have a similar measure for Canada. It doesn't exist. We generally have a bit more opaque central bank. It doesn't disclose minutes to its meetings. It doesn't disclose voting patterns or measures like this. But generally speaking, the heads of central banks sounded somewhat more strident in their belief that inflation was transitory than perhaps the cross-section of opinions within their committee. And I think you saw that generally also across the forecasting community. Many people relied more upon narrative economics to emphasize that we were downplaying inflation risk too significantly. That includes Scotiabank economics. We started to raise the alarms on inflation risk and upside risk in writing back to late 2020 and accelerated those warnings. We felt there was far too much emphasis upon one side of the inflation bet in terms of the public policy discourse and in the markets at the time. Why did that happen? On the next slide, I think it's in part a function of the fact that we went through a bit of an unfortunate period where instead of paying heed to emerging evidence on inflationary pressures, the rising breadth, the month-over-month gains instead of the year-over-year gains, all we heard was that it's transitory, it's base effect driven, it's one or two items, gasoline, for example. We had evidence a lot earlier in the process than when we finally saw central banks started to pivot, that there was something deeper going on here. So why did all sorts of smart people, tons of them at central banks and in markets and in private forecasters, not pivot a little bit earlier in the game? And I think some of that might be, we're creatures of habit as forecasters, as humans. We had adapted to a protracted period of low and stubbornly low inflation that tended to disappoint every time we thought we were getting liftoff. There were structural reasons for that in the past. It may have also been because there was a change in implementation frameworks led by the Federal Reserve at the August 2020 Jackson Hole Symposium with the revised statement on longer run policy goals, and the Bank of Canada's greater willingness to work the range toward the upside in terms of implicit bias that it signaled to the markets. But generally speaking, I think there were, in the early stages, some unfortunate arguments that clouded a cleaner reading of some of the inflation data as it was evolving. Next slide also perhaps brings it home in terms of lessons to be learned from this exercise. Humility, number one, including central banks. The Bank of Canada's historical track record of forecasting inflation, the dashed lines on this chart versus the solid red line, which is how inflation actually performed, is not particularly flattering. And I'm not picking on them. You could substitute many other inflation forecasts on the same chart. But the degree to which they communicated to the markets that inflation was something to fully look through, it would fade in magical fashion, I think belied a bit more of a circumspect approach that would have taken much more of a risk management policy approach to development that took into account new information as it was arising. And perhaps we could have hiked earlier in the process in a way that took out some risks against being wrong on the transitory argument, while at the same time maintaining enormous amount of monetary stimulus by still remaining below what most economists estimate to be a neutral policy rate range. The fact that we went all in on one single bet in one single scenario for inflation, I think explains why now we're having to expedite those rate hikes, creating a lot more economic anxiety, a lot more financial market uncertainty, and central banks, in retrospect, while overstating their ability to forecast inflation, probably overcommitted on their forward rate guidance by promising something that nothing in the economics literature or in theory can really promise people. Have been dealing with on the next slide. I won't go over each of these points, but we'll emphasize a number of them because we've been grappling with the exact same issues in terms of our own track record and forecast uncertainty as central banks. Well, there's no playbook for a pandemic. There is no playbook for a pandemic followed by a war. There was great uncertainty with respect to how behavior might adapt, how policy may adapt, how the supply side may react relative to the demand side throughout every phase of COVID-19 cases that we went through. We may have started to observe structural changes in the drivers of inflation before the pandemic struck, and those forces magnified the structural changes. We cast aside former Fed Chair Ben Bernanke's concern that perhaps in retrospect, he should have done even more in the earlier stages of the global financial crisis. By this time, getting all hands on deck much sooner across both monetary and fiscal policy levers and across the world. The magnitude across all policy levers and the degree of coordination was unparalleled in response to an unparalleled shock. And I think that deserves great credit. I think they saved us from a depression. I think they saved us from deflation risk. I think we have to acknowledge that in terms of the balanced set of conditions here. Enormous credit to our public policy officials on that count. But they pivoted a little bit later than would have been appreciated in terms of the scope of risks that we are now facing. On the next set of slides, I'm going to go relatively quickly because I think there may be scope to discuss this a little bit more freely in the discussion period that follows the opening remarks that I'm delivering. But the issue is widespread cynicism across Main Street and client segments and financial markets that perhaps we're not measuring CPI inflation as accurately as we should. I'm not a terribly big believer of that. I think there have been a number of good studies, both at the Bank of Canada on the next slide and the Statistics Canada that are highlighted here. And I'm not going to read these points in the opening comments. These slides will be available on the website afterward. But the punchline is that most of the measurement error in its various forms, like the speed with which it incorporates new products or the speed with which it captures substitution and income effects within the basket. And most of those forms of measurement error tend to get overstated, as well as quality adjustments in terms of the literature's attempts at estimating them. And we're probably getting much better at it, if for no other reason than the fact that we are increasing the frequency with which we revise the CPI basket weights. We're now turning to revising them annually, which should moderate a lot of that concern about measurement risk, which was probably overstated to begin with. I'm going to skip ahead to the next slide to emphasize one important exception here. There's no good excuse for why Statistics Canada, in my view, omits probably the hottest category in North American inflation these days, which is used vehicle prices. They have had this as an issue of omission for many years. It really bit them during the pandemic when used vehicle prices started climbing 40, 45, 50% across North America year over year. If we were to include that in the official inflation statistics, which they have announced in February that they are working toward, then you would probably add at a minimum 1 percentage point, maybe up to 2 percentage points to headline inflation in Canada. That is a strong caution because our policymakers should cease this tendency to declare that Canada is managing inflation risk better than other jurisdictions like the United States if we're omitting the hottest category that's lighting up inflation these days. Going ahead to the next slide, I think I'd like to actually flip ahead to the inflation forecast portion next on slide 11. Karen, there we go. Having said that, Next slide, please. Yep. Having said that, we still have to give it the old college try to forecast inflation. The track record isn't great. There was a more diverse array of opinions on inflation risk that should be more accurately embodied within policymakers' decisions and their approach to their frameworks. Measurement error is overstated, but we still have to make an attempt, and I think within reasonable bounds, to forecast inflation. Just as a business can't simply throw up its hands and fail to attempt a business plan because of uncertainty, or individual investors cannot think about the market conditions and expectations because of uncertainty, or that governments can't plan budgets. We still have to make this attempt, and I think with some reason to believe that on balance, we can expect hot inflation numbers for an extended period of time. And on this count, we tend to be toward the upper end of consensus opinions as it applies to Canada. This chart shows our forecast. We expect about 6% annual inflation this year on an average annual basis. The peak will be much higher than that. That's an average annual rate, coming down to just over 3% on an average annual basis next year. That means a persistent overshoot of the Bank of Canada's 2% inflation target, especially if they don't do what we think they should do, is to raise the policy rate from a 0.5 percentage point now after their quarter-point rate hike up to a terminal rate of 3 percentage points, overshooting most estimates of the neutral policy rate by a moderate margin going forward. What are the ingredients to this? On the next slide, I am very fortunate to work with some very strong team colleagues. René Lalonde, for example, and his colleague Nikita on our team. They are individually very well trained, very experienced econometricians and modelers. And we thank the Bank of Canada as well for providing them the experience in their careers and the good work that they did while at the Bank of Canada. They have developed an augmented Phillips curve framework using a supply chain variable that they feel accurately reflects today's supply chain pressures in the context of a more traditional Phillips curve framework. It fits recent history fairly well, that model, and it is the workhorse model that we use to project inflationary pressures to subside gradually on the condition that monetary policy tightens as much as we expect it to going forward. The drivers on the next few slides, starting with this next one here, yes, include the fact that we have closed all spare capacity, according to the Bank of Canada, or very close to doing so, according to our own forecast, and moving into a period of excess aggregate demand as embodied within the concept of output gaps. So basically, if you're above the horizontal line on this chart, you're in net excess demand conditions, hotter demand than supply, the ability of the economy to meet new demand at the margin. If you're below, then you're still dealing with slack. We've shut off a lot of the slack we had earlier in the pandemic. This model on its own, a pure output gap framework, didn't explain much, hardly any of the inflation that we've seen over the past couple of years. But we think going forward, it will combine with some other important drivers of inflation that see excess aggregate demand married to a whole suite of additional factors I'm going to rattle through over the next few slides before we move into the discussion phase. On this next one, we are dealing with exceptionally easy monetary policy. The way to look at it is in real policy rate terms. That's the way any macroeconometric model would embody the policy rate and forecasting real increased, and more importantly, expected inflation increased. Central banks were engaged in a period of neglect. They let that happen without pivoting as rapidly as they should have, and the real policy rate plunged by hundreds of basis points. Just as the economy was getting beyond the period of truly exigent circumstances, policy eased to an even greater extent. And we think it's going to take until 2023 before we get back up toward a more neutral nominal policy rate and a more neutral real policy rate, and back toward a zero range forecast on that count. This is a massive amount of easing, also backed up on the next slide by quantitative easing measures that are now turning to quantitative tightening. I strongly endorse the Bank of Canada's move, I think, to move toward ending reinvestment with no roll-off caps in the April meeting. I think they need to shrink their balance sheet fairly rapidly. And the Federal Reserve is likely to take a bit more of a measured approach with higher roll-off caps than before, but still at a relatively moderate pace compared to the Bank of Canada in our forecast. I'd also encourage you to look at the next slide, which one issues. This is the semiconductor shortages, the fact that if you want to buy a car, you can get most of the components except for everything that runs on a chip. So you're waiting for inventory and you're dealing with empty dealer lots. Semiconductor prices have soared along with other electronic components, memory chips, for example. We may be starting to see a little bit of relief. This is a sector that is notorious for swinging from one side of the ship on underinvestment towards overinvestment the next moment. I think, however, these supply chain difficulties are going to be with us well into next year at the same time that we are moving into net excess aggregate demand. So the supply chain challenges that drove some of the inflation to date are going to be complemented by that net excess demand picture going forward. The next slide, another way of reflecting that is the fact that you've perhaps noticed if you've tried to buy a stove or a fridge or a car or many other consumer items, the first thing you're told is to wait. And you see reduced product selection and bare shelves. The inventory to sales ratios across broad sections of the retail and broader business landscape in North America are relatively quite low at the moment. And I think that tends to create a little bit more pricing power on behalf of retailers, particularly the digitized retailers. We're also on the next slide dealing with a move beyond, by our estimation, maximum employment. We're not only 370,000 jobs above where we were before the pandemic in Canada, we're below what most economists would describe as the non-accelerating inflation rate of unemployment, the NAIRU rate, which is subject to, like everything else, its own measurement error, its own uncertainty. But we have a fairly significant degree of confidence that the unemployment rates that we are achieving now are below what is sustainable without generating wage inflation. And to that effect, we are seeing wage inflation since last summer. On an average month-over-month annualized basis, seasonally adjusted, we're dealing with about 6 or 7% average inflation wage inflation since last summer. The next slide shows how this is particularly problematic. Present company excluded, the overall labor force in Canada is enjoying wage hikes on balance in exchange for producing less. Productivity, the dark blue line on this chart in Canada, is in a miserable state. And until Governor Macklem's very recent speech, it was getting no attention in policy circles in Ottawa. In the long run, most economists would tend to argue this is your best single predictive gauge of long-run real wage and income gains. It's disturbing that we are seeing our experience coming out of this crisis compared to coming out of the GFC and relative to the US being so poor in terms of our ability to produce goods and services. The way in which you combine all of these measures, one way is unit labor costs, shown on this chart, total employment costs, wages, salaries, benefits per unit of output produced. Those productivity adjusted wages have accelerated even starting before the pandemic. And that reinforces our inflation fears on a go-forward basis. I'd like to also fast forward to the next slide to note that we think that the household financial conditions, particularly in the US, but also true in Canada, are more conducive to price pass-through effects by businesses looking to raise their prices. The US household debt service burden, the share of after-tax income going towards debt payments, is at a record low. Home equity in Canada and the United States has soared. Leverage ratios, debt to asset ratios have declined precipitously since the global financial crisis. Household debt service burdens in Canada as well have declined as we transferred more income to households than they lost net from the pandemic, and now we're dealing with the rebound in privately generated labor compensation to carry that forward. The household saving rate is still elevated above levels that we've seen in recent years, and there's a mountain of cash sitting on household balance sheets in both countries. I think that gives us a period of time in which we should be looking at a broader suite of numbers in terms of the financial ability of households to absorb these price pass-through effects and keep inflation pressures going, as opposed to strictly a narrow focus upon real wages, for example. we're coming to the close of the main points that I wanted to make, but I think the next one is critically important to Canada during wartime circumstances. The next slide for the terms of trade in Canada has me being a little bit cautious in the words I choose. I certainly wouldn't like a headline that war is good for Canada, but in a perhaps perverse sort of way, it kind of is. We're selling our commodities-driven exports at higher prices relative to the imports, the price for imports that we're having to pay. That was a process that was starting before the war. It became further inflamed. This data is behind even the higher frequency markets data that we can observe. What it means is that if we're selling our products at a higher price abroad than we're having to pay for other people's products coming into the country, it's like a net imported positive income effect. That trickles down. Former Governor Poloz did an excellent job explaining this in a number of speeches in the past for further reference. But in essence, it means government balances can improve, corporate profits can improve, not evenly, but in particular resource sectors, and there tends to be a positive trickle-down effect into household incomes. On top of the ability of household finances, I think, to absorb the greater price pass-through, we'll get this income lift coming into a country like Canada because of the nature in which the war effect is impacting global commodity markets. I'm going to skip 2 slides ahead to the inflation expectations one and come to a close because I want to make sure that we get on into the question and answer section and the discussion phase. This is the chart that I think keeps people like Governor Macklem, Jay Powell, and other central bankers awake at night. It is their Achilles heel. It is the risk that high and rising rates of inflation become embodied in expectations, that people start to treat it as something that has legs. And people no longer care about, well, what's driving it? Is it the demand side? Is it the supply side? Is it a combination of both? Is it idiosyncratic factors? When you start to see this evidence of extrapolative behavior in Bank of Canada surveys, this one being the January round, we get an April round of updates on Monday's surveys, and in other market-based measures, that's suggestive of the point that people no longer care what's driving it and expect it to persist. And that puts central banks behind the 8 ball. That is why they are, I think, almost in panic mode now with respect to having to tighten monetary policy in order to ratchet down those inflation expectations to avoid it becoming a self-fulfilled prophecy of persistent upside risk to inflation compared to their targets going forward. I'll leave it at that for now in terms of opening thoughts, and I'll very much look forward to the discussion with Jason and with others on the call. Thank you.
Thank you, Derek. We'll now turn to the Q&A. A reminder, if anyone in the audience has a question, we invite you to type it into the chat box on the bottom right of the screen to all panelists. So for our first question, looking at the Bank of Canada's preferred inflation measures, what is your assessment of the BOC's preferred target indicators? And related to that, are there other indicators that you would suggest should also be used or monitored?
Okay, great question. That's one of the challenges in being a street economist and dealing with institutional clients and others in the markets during a period of accelerated inflation worries is the fact that, in my opinion, the Bank of Canada has confused markets with respect to what measures of core inflation it is targeting. It throws everything at the wall. We've got 7 measures in terms of the year ago monetary policy report that they emphasized in a special box on core inflation. One of the most frequent questions is, well, which one or small subset of these really matter to the Bank of Canada? And that's a very frequent point that gets raised by market participants and a broader suite of clients. I think they've overcomplicated it. I think they've introduced an overly great array of competing measures that don't necessarily all outperform one another, and that they should err more on the side of simplicity. And on that count, I mentioned René Lalonde and his colleague Nikita earlier on. I'm going to pull upon a piece that they did and give it a bit of a plug here because I think it deserves one. In June of last year, they put out a piece, Core Inflation at the Bank of Canada, Should We Get Back to the Basics? Through a number of forms of testing, they concluded that CPI, ex food and energy and indirect taxes, very simple measure, actually outperforms most of the other ones on a number of counts. One, it's simplicity. Two, it does a better job of predicting future changes in CPI from a convergence standpoint. And three, it's best explained within a Phillips curve framework compared to the other measures of core inflation. So tick, 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 why aren't we using it? It's, I don't think that we should abandon all the other measures. There's still a rich variety of information to them. But I think 7 is probably too many in relation to the risk of confusing market participants.
Following on to that one and looking internationally, the 2020 book by Charles Goodhart and Manoj Pradhan, The Great Demographic Reversal, contends that this decade will see an end to the excess global supply of labor and savings, as well as lesser globalization of production. All three of these were major disinflationary forces from the 1990s through the 2010s. What is your view about structural trends in global inflation during the 2020s?
I think it's a fascinating area of inquiry. I only have suggestions to offer in the direction of pointing to the risk that cyclical impulses to inflation risk, I think, are going to be compounded by a set of structural changes that are pointed higher on inflation risk going forward than we became accustomed to over the 10 to 20 years leading up to the pandemic. One of which being demographics. It may be in a North American context and elsewhere through aging populations, creating slower growth over time in the rate of growth in labor supply. That could mean tighter labor markets than we've become accustomed to in the past, maybe greater productivity pressures relative to wages. That could be a greater form of cost pressure type of inflation than we've tended to deal with. Some of these types of structural changes we could evaluate before the pandemic evolved. And that's why I always felt it was a bit unusual to hear very smart people, and Jay Powell in press conferences, relying so heavily upon past structural drivers of inflation when we knew that there was some evidence that they were already changing into the pandemic, like demographics, like trade policy. When China rose and became a member of the WTO in 2001, that was basically the last significant impulse on trade liberalization that we experienced. And through US, China, other bilateral trade disputes that emerged after the 2016 election, we started to see those trade tensions bubble up and challenge global supply chains, tighten them up. Perhaps they were becoming too dispersed and exposed to vulnerabilities on trade policy changes. And so now we're probably in a period in which that trade liberalization is going the other way. Not enormously so, but at the margin, and certainly in terms of the impacts of policy tools like the weaponization of financial instruments and sanctions. So that too is changing. I think technology may also be changing as an inflationary driver. At first, it lowered barriers to contestability. It increased information flow. Now I'm not so sure. I think there's a case to be made for how changes in distribution, changes in way distribution channels, changes in ways consumers source their products may have created more market pricing and market power on behalf of the whole digitalized segment of the economy. And that too might suggest that we are seeing greater limits to the disinflationary influences of technological change in the past on a go-forward basis. So if that's true, we really need to be careful of managing inflation risk if structural drivers are changing at the same time that we're dealing with all of these other cyclical influences.
Thank you. Turning to additional questions on the chat line, could you comment, please, Derek, on the interplay, correlation, whatever term you would like, between inflation risk with credit, market, and liquidity risk, especially in the current circumstances?
Yes, sure. And so it's there are multiple angles to approach on that one. But I think in general, I think one of the biggest vulnerabilities to having misread inflation risk over the past year or so is that credit risk and asset price inflation in general downplayed that that threat to markets excessively so. And I know historically we have plenty of evidence to the effect that when the Fed and other central banks pivot toward a tightening cycle in response to inflation expectations and inflation risk, the stock market wobbles a little bit, but tends to shake it off and rally over time. We're in very much uncharted waters in terms of present circumstances, dealing with the unwinding of quantitative easing, dealing with the tightening traditional policy rate tools that they have at their disposal, in the context of a lot of still elevated uncertainty around inflation risk and what the outlook for the North American economy and the world economy as central banks tighten in response. And so I think some of these measures of credit risk premia, S&P and other stock market valuation measures had to take some of the froth out. It'll be a big experiment to see whether they took enough out over the duration of this year.
Picking up on that in a different direction, a further question from the chat line. Looking at the inflation risk premium in nominal bonds, as we sit literally at the end of the first quarter of 2022, is this premium sufficient now to compensate nominal bond investors for positive inflation surprises?
Right. I think the very longer ones have gotten to be sufficient. If we go out 5, 10 years and beyond, it's always something to be treated with care, particularly in Canada, because I think our inflation compensation measures aren't the greatest, and they can suffer from liquidity distortions to a number of these benchmarks. For example, real return bonds tend to be infrequently auctioned. They tend to be snapped up at auction very quickly and then sat on balance sheets, particularly for firms that have long-tailed asset liability matching requirements, and pensions and others. And so we have to be careful in terms of an overly literal interpretation of these measures of long-run inflation risk. But I'm more comfortable about the longer run pricing of that risk, less comfortable about the nearer term over the next 2 to 3 years. I think we're going to really struggle to get inflation, the inflation genie back into the bottle, given how late policy is responding and given the confluence of factors that we think are all pointed in the same direction.
Thank you. And related to that, another question. How do you see the impact of carbon tax pricing affecting Canadian inflation and the cost of energy going forward? You can feel free to address that in direct terms, indirect terms, and also recognizing that some of this is prospective as compared to fully being legislated.
Yes. Okay. Well, the latter part, I think we're fairly confident that it will be legislated and that it is a real factor. I think we have a public policy bias in Canada that is treating greenhouse gas emissions and achieving more sustainable, longer run environmental policy goals very seriously. And so I would expect them to stay on that general track going forward. I think the first round influences are inflationary at the margin in terms of the trickle down effects upon everything right down to the price of gas at pumps. The second round influences, I'm less convinced that they are durable in that regard. That if we are shocking the prices of carbon-related prices over time, items, then it risks becoming disinflationary, all else equal, on other parts of the basket in terms of crowding out some of the purchasing power. I don't think that's a big concern in the relatively nearer term because these policies will be being gradually implemented over time with lags. There will be adjustment periods to them, and there are more dominant forces in the relatively nearer term, the next 2 to 3 years. But longer term, it's I think the extent to which that second round set of influences crowds out pricing power could be a dominant influence at that time.
Picking up on the credit risk implications of rising inflation, how do you view their risk, especially highly indebted borrowers in the leveraged finance space currently?
Sure. Okay. So I think there are definitely going to be some painful adjustments across households, across businesses in terms of dealing with rising interest rates and higher cost of funding. But I think they'll be manageable on balance. I think let's look at, for example, even the household part of the balance sheet picture in a country like Canada. The rate shock that we're dealing with relative to the B20 OSFI guidelines is relatively modest compared to what they already had to qualify at. If we take the best offer mortgage rates and how they've moved up already, plus 200 points or so, we're a little bit above the qualifying rates that they already had to meet. And so the incremental rate shock at the point of qualifying in the housing market, I don't view as a terribly large shock compared to the macroprudential rule requirements that already existed. I think there are also plenty of ways in which second round influences can adjust in response to a rate shock. There's a lot of home equity out there. There's flexibility around the contracts with respect to extending amortization periods, for example, maybe doing a bit of cash out refinancing on those home equity guidelines, maybe raising loan to value ratios on refis and renewals. And there are lagged influences that are spread out over typically years in terms of adjusting to higher policy and market rates as various forms of business and leveraged and household loans come up for renewal. But at the end of the day, monetary policy will have failed if it doesn't cool these interest-sensitive sectors and these forms of activity. That's the very essence of the exercise, the whole point to it all. And so I think it's also important in a fuller debate to point to expectations for how we expect services, exports, business investment to do a little bit more of the heavy lifting on growth over the next few years compared to the interest sensitive sectors, the leveraging activity that drove much of the growth in the past couple of years. So a bit more balanced set of growth drivers than we've seen so far in the pandemic.
Turning to the asset side of the discussion today, there's been a host of secular demand and supply factors pushing up house prices in Canada, but the cut to near zero policy rates and massive quantitative easing of the Bank of Canada also contributed to Canada's house price surge since mid-2020. Looking today at the circumstances, and you've nicely led into this topic, should the BOC be focusing more on house prices given the impact of low mortgage rates on demand for the housing market specifically, but also the situation with housing cost contribution to the CPI directly?
Great. Okay. Very important question. I know this is going to be contentious with some, but yes, I do believe the Bank of Canada should treat this much more seriously. When you have the confluence of both asset securities pricing, inflation with traditional inflation measured in gauges like CPI, all occurring at the same time, it's a dangerous combination. All right. I think we relied excessively upon macroprudential rules to stymie some of the rate pass-through in terms of appetite for housing and soaring house prices. Those macroprudential rules may have stalled some of it, but they really didn't change the picture in any profound way. The late finance minister, Jim Flaherty, when he first started to introduce these tightened rules back in 2008, straight up to today, they did nothing at the end of the day to forestall the record high premiums that we are seeing for prices in the housing market and the impact upon housing demand through resales and home ownership rates. They may have slowed that process, made people adjust in other ways. There may have been ways of circumventing some of them at various points along the way, but fully relying upon macroprudential policy tools as a way of stymieing that pass-through of cheap borrowing costs and preventing real struggles with housing affordability is something that didn't work, in my opinion. It's also being offset by other inconsistent signals in terms of housing demand. If the effort is really to cool it, we're dramatically raising immigration targets, which I think is vital and very important in many respects in terms of labor shortages, for example, in terms of an aging population over time, in terms of funding our pension liabilities and a whole host of debates. But it's an added source of positive effects upon housing demand over time that at the same time that central banks will be trying to tighten the cost of borrowing. I think it's also important to look at a broader array of housing influences beyond the traditional buy to own and live in segment. Raising the cost of capital on the investor segment, I think, would be a constructive exercise. We know from Bank of Canada research, for example, and others, that it's becoming a hotter segment of the marketplace because of the extraordinarily cheap cost of capital. And generally speaking, that's one of the warning signs that froth is starting to get excessive when it really pushes into the investor segments that we are seeing in Canada. I think it may also be an important signaling effect in terms of invoking some discipline and how people stress and scenario adjust their household finances in different rate environments. And it's, I think we should also consider that maybe lean versus clean, that debate has to be refreshed for today's realities in terms of financial innovation. Because when you have so much, for example, by way of home equity financing products that are out on the marketplace and very easily tapped, it maybe perpetuates the housing pressures, perpetuates the froth argument in ways that policymakers, monetary policymakers, should be looking at in terms of repricing those forms of credit that have become much more powerful in their role within the financial system. And so on balance, if you had extraordinarily low inflation, but high and rising house prices, it'd be a much more difficult decision. The Bank of Canada's mandate is 2% inflation on a CPI basis. I can see the case for not paying excessive attention to housing affordability issues from a monetary policy standpoint during that period, although I think we overstimulated it. But now there should be no debate. Now you've got all of these combinations in the same direction. And that concerns me if we don't address it properly about the risks to financial stability over time.
Thank you. Derek, you've nicely introduced capital markets elements to this as well. And one of the questions, and feel free to include the Fed as well as the BOC in these comments, various observers have focused on issues around the buy the dip mentality, the situation with the so-called Fed put, that if there's significant capital markets weakness, specifically equity markets, that it will be difficult for central banks to keep on their tightening path. How do you look at that type of risk or that type of scenario in the current environment as compared to, for example, the post-GFC decade?
Right, okay, important question. It's, I think there's a much higher bar set against triggering the Powell put, if you want to refer to it, or the Fed put more generally, than in the past. In the past, that there was perhaps a lower bar set because central banks were not really under anywhere close to today's inflationary pressures and the fundamental challenge to their core mandate, which is price stability. Even for the Fed's dual mandate, it's how the labor market feeds into the price stability part of the mandate that is now dominating. And so you didn't tend to have that degree of worry about falling so far behind core inflationary pressures over the post-GFC period that you have right now. And that's, I think, what we're reading from signals sent by Powell now and other Fed speakers, that there's a considerably higher bar from the standpoint of disrupting equity markets or disrupting other benchmarks in the financial markets to hold off on those rate hikes. I also think that part of the issue is maybe the uncertainty around the bond market, the slope of the yield curve. Is that signaling equity market worries? Is that signaling recession risk going forward? How seriously does the Federal Reserve treat that in terms of how it all loops back to the equity framework as well? I don't sense that they're terribly worried about it. And there's an interesting piece put up by Fed staff economists at the end of last week, revisiting what is the best yield curve slope measure. And it's basically the one that performs the best at forecasting recession and also for trouble to equities and risk assets, is the 90-day bill ratio, rate spread compared to the 18-month forward expected yield on a 90-day bill. And that relatively shorter spread measure outperforms 2s 10s, outperforms 90s 10s, and other gauges of the slope of the yield curve when it comes to predicting inflation and terrible things happening to the risk trade. Looking at that measure, there should be no worry. It's, I don't know what it is today, but at least yesterday, last I checked, it was about 245 basis points on the positive side. Very, very constructive at the margin. that's going back to the kind of stimulus signals that we see from the yield curve back in the mid-2000s. A number of years later, conditions turned, but for a good period of time and around the middle of the decade, the U.S. economy and a lot of these measures performed quite well. It may well be that the right measure of the yield curve and from a risk asset standpoint is signaling something more toward the boom side of the picture rather than the bust side in terms of risks going forward. So I think that's the way the FOMC and the Fed chair and other central banks are probably closer to looking at it as opposed to taking a literal interpretation of a relatively flat 2s, 10s curve and the risk of overdoing it in terms of tightened monetary policy, the risk of triggering a policy put that would stall them in their tracks. And finally, very briefly, they have a lot of balance sheet tools at their disposal if they wanted to really go hard at raising the term premium on some of these bonds and try to steepen up the curve a little bit further out.
The comprehensive answer is quite appreciated. And one aspect I wanted to pick up on the asset market, again, with capital markets, is how do we gauge the shape of the yield curve given the sheer size of the Fed's and especially the Bank of Canada's balance sheet? And the fact that even with the forecast on the charts that you showed, the Bank of Canada will end up with a much higher percentage of the Canada bond market after it gets into the bond tapering phase than before the pandemic.
Right. Well, it's this is where I worry about the need to reverse their ownership shares of bond markets, not just for the Bank of Canada, but for global central banks in general. And the fact that we've exhausted the usefulness of quantitative easing programs and we've arguably gone in the direction more of net disservice to financial markets and the broader economy writ large. Across quite a number of economies now, we're dealing with 45% of the European government bond market now held by the ECB. It's about 45% share of the Canada bond market that's held by the Bank of Canada. 35% of Aussie bonds. The Fed owns about ballpark 30%. The Bank of Japan is more like 50%. The Bank of England is right up there in terms of its ownership. Inordinate shares of bond markets held by people not experienced with respect to managing those complex portfolios, removed from the private markets, reducing price discovery, reducing discipline in terms of the signals that are sent in terms of rationing credit allocation to its most optimal parts of the economy, probably encouraging excess government spending, in my view, compared to what would have otherwise been the case if we didn't have this central bank-induced scarcity of tradable assets that has raised their prices and lowered their yields in ways that fundamentals can't justify. And so we're dealing with a very, very distorted bond market with multiple unintended consequences that has now set a very challenging set of circumstances for the yield curve and for bond investors in general, because you don't have any reward for duration risk, for accepting duration risk across the curve right now. And I think they need to be careful going forward in terms of the habit they've adopted with respect to treating quantitative easing not as just a tool to be used under truly exigent circumstances with an abrupt liquidity shock and outright freeze in the financial system, and instead viewing it as something that they can lean on for years at a time, long after the worst conditions of the crisis have passed, in a way that directly interferes with private market functioning. And there's a lot tied up into that, but I think it makes the world of bond management and the risks around it more complex with a potentially disturbing array of unintended consequences.
Picking up on that theme, we're coming to the last few minutes here. If I look at the rise in Canada bond yields in early 2022, and we're of course just completing the first quarter, real yields are deeply negative, whether we use reported inflation or surveys, as your charts have shown. What level of real yields do you view as the neutral outcome of unwinding the BOC's pandemic stimulus? And do we need greater term premiums in the Canada bond yield curve to reach a neutral outcome?
Okay, sure, Jason. It's well, I guess the stock answer many economists would have would be that estimates of the nominal neutral policy rate applied to Canada, for example, would probably be, if we use Bank of Canada research, between a 175 and 2.75 percentage point range. The range that we tend to use is roughly in the middle of that in terms of our macroeconometric models and the impact upon growth, inflation, measured by the distance of the actual policy rate from that estimate of the neutral policy rate. And so in real terms, if the bank succeeded at achieving their 2% inflation mandate over time, then you should have a real R-star rate in Canada, not that far different from zero, maybe slightly positive. Maybe a little bit more positive if we go to the very outer bounds of the Bank of Canada's estimated ranges in that 175 to 275 nominal R-star range. So I think we're quite a distance from that where we are now with a 0.5 percentage point nominal policy rate. I'm not sure that just getting up to 2, 2.25, 2.5 is going to be enough in this cycle because of how slow-footed and how long they took to adjust to emerging inflation risk in this cycle. And so that's why, relative to other shops, we're a little bit more aggressive in going with a higher terminal rate overshoot toward 3% into the early stages of next year, compared to that 2.25 range neutral policy rate. And so that should leave us with a slightly positive real policy rate that far out. But over time, I would expect some convergence towards something that's closer to in and around zero on a real neutral basis. Do we need a higher term premia across the bond curve? Absolutely, I think so. I don't want to really see the uncertainty in markets around what happens when we run the risk of an inverted curve if central banks really go hard at the front end and the longer term maturities stay relatively stuck, 2.5, 10, let's say, in that range. I'd rather they took measures at their disposal in somewhat of a coordinated fashion to steepen out those curves a little bit so we don't have to have that risk, even though there is this evidence that it's not the best measure of the yield curve in terms of predicting doom and gloom and for the economy and risk assets. I'd rather we just avoid that whole debate. And we see the need to avoid that in terms of the tone of financial press headlines on a day-by-day basis now. The financial press is obsessed with arguably the measures that research tends to suggest aren't necessarily the optimal ones, like 2-10 spreads. And so the confidence impact, the uncertainty effect in markets, I think are best avoided if we take steps to try to steepen out that term premium, that central bank policy absolutely crushed to levels we haven't seen ever on record back to the 1960s at least.
Derek, thank you. I'm going to be unfair in less than 1 minute. Last question. On the topic of when central banks should have pivoted, when do you think the Fed and the BOC should have done that?
Okay, 1 minute. All right. So bottom line, I think they should have shown more balance in their inflation perspectives last spring, last summer, and they should have been pivoting toward later last summer toward conditioning people to expect tightening monetary policy, and they arguably should have been delivering hikes toward the end of last year at the absolute latest. Not having done so, that's why we're talking 50-point moves, perhaps a series of them now because they've waited too long to adjust.
Thank you. With that last comment, we've come to the end of our time today. Once again, Derek, thank you very much. Broad-ranging, comprehensive, and very informative. To all attendees, thank you for your participation today. As mentioned earlier, a prompt will appear to complete a post-webinar survey when you leave this session. Your feedback is valuable to us, so please do take a moment to fill out the survey. I also want to remind everyone of the next webinar in GRI's macroeconomic series. On Thursday, April 14th, during 1 to 2 p.m., Stéphane Marion will be the featured speaker for our webinar, Macroeconomic Lessons from the Pandemic. In closing, many thanks again to everyone for joining us today, and I wish you a good afternoon.